Welcome back to Reimagine 2020. I'm Yonah Hochhauser, and today I'm glad to be joined by Corey Caplan, partner of the DMM Foundation and co-founder of Dolomite. Corey, thanks so much for joining us.
Thanks. It's a pleasure to be here.
Well, so for those who don't know you, you want to give a little background, kind of who you are and how you got into this whole blockchain thing?
Sure. So I've been working in the blockchain industry since about 2015 or so. Really exciting times to be in here. I first started off as more of a user of the industry and slowly working on different bounties for different organizations and found myself really diving into the technology side of it, really trying to understand the ins and outs of the smart contracts, the systems that actually run them, the blockchain, consensus, all that stuff. And just like everyone else that probably got involved in the industry, realized how deep the rabbit hole would go and also how interesting the rabbit hole could be as you dove down it. So back in early 2018, I co-founded Dolomite with my business partner. Then in late 2019, started to get involved in DMM or DeFi Money Market with Greg and Derek of the DeFi Money Market Foundation. And overall goal though is just to build really cool products that really just help people. DeFi Money Market's really focused on bringing real world assets on chain to help diversify people's portfolios and offer broader access to a wide range of financial instruments. So leveraging blockchain and crypto and smart contracts to just help the world.
Mm-hmm. Now, we're talking about DMM and putting real world assets onto the blockchain. There's already a couple of issues that just jump to mind. One of them being that the kind of the beauty of the blockchain is that everything on chain, it's trustless, it's immutable, it all goes by the code. You can't, whatever the code rule says, that's how it goes. And there's kind of no getting around it. There's no, backing out of deals. It's set in code. But when you introduce real world assets, all of a sudden there's a whole, it's outside the code world. It's physical. It's hard. So how do you kind of combine the two? How do you, I could guarantee a loan on the blockchain because, if there's a smart contract, it'll automatically trigger and there's collateral. How do you guarantee things once you're going, into the real world?
Yeah, so you definitely bring up a couple of really good points. And the first is when you're looking at just a very pure on-chain world where everything is kept inside that silo, everything is very sanitized and very clean. But as you start to inject real world assets and inherently human interactions, it becomes much messier. So if we unwrap this idea that things need to be completely sanitized for a moment, it starts to become a lot easier to build certain rules out around a system like this. So first and foremost, we try to leverage the best aspects of smart contracts to basically to concede the fact that we're not going to be able to be 100% sanitized. Everything will trigger with 100% certainty and things like that because we're dealing with the real world, which unfortunately has that aspect of uncertainty. Whether we can get it to 99.9% assuredness, that's still not 100%. So we unfortunately can't take those assumptions. So instead, what we really try to do is architect a system around the idea that most systems like this that would exist in the real world that don't use smart contracts are inherently not transparent, are inherently difficult to follow, can be rife with fraud, unfortunately, or other potential issues. So instead, what we try to do is architect a system that is inherently transparent from its core layer, which is very, very feasible to do because of smart contracts. That was the easy thing. But the more difficult thing was trying to bake in some more of these certainties or assuredness. So what we really try to focus in on is what are the rules that we can control for the parts that are on chain? And then for the parts that are brought on chain from the real world, how can we make that as trustless or as trust minimized as possible? And then if we really try to bake really strong controls around the movement of funds that do exist on chain, then we can start to build a better system around this sort of solution or around this problem that the solution's posing. So happy to dive more into that, I guess, as this conversation progresses. But from a high-level overview perspective, it's really just about putting as transparent and smooth controls in as possible. And then giving people, because at the end of the day, all the blockchain users are people, giving them time to react to these changes. If they don't like the way that our system is going to evolve, well, it's a good thing there's a time delay in place so they can react accordingly without potentially having a rug pull happen or something like that.
Yeah, well, we'll get into the DAO, also further in the conversation. But I guess before we dive in too deep, just give a quick rundown, a quick example of how tokenization on DMM works, in terms of, just use an example, take a real world asset, and what's the process from that real world asset to actually tokenizing it and implementing it into the blockchain ecosystem.
Sure. So looking at it first, like, from the user's perspective, because it would be probably a user's trying to understand the journey. A user first deposits their crypto or their funds into our protocol, and they get in return something called an M token. So they'll give us DAI, USDC, ETH, USDT, etc. And we spit out an M token variant to that. So if they give us USDC, we give them MUSDC. It's essentially a tokenized representation of their balance in the protocol. It accrues the interest that we offer in real time. And it allows them to also potentially trade that M token with other people in case we're hitting economic restrictions or what's called our debt ceiling in terms of activity in our protocol. So behind the scenes then, once the funds are in our protocol, at some point in the future, what we can potentially do is draw down some of those funds into the real world then. But the important thing though, and this is where I start to get into more of the technical stuff that we mentioned before, there's very strong rules around how much can be drawn down and at what time period and who is able to draw down the funds. So we'll probably talk more about those rules and things later, but it's worth noting where these rules start to come into play and where they really matter. But with that, the funds that get drawn down then essentially are sent off to what's called a loan servicer. The loan servicer is essentially a portfolio manager that's actually able to acquire liens to these real world assets that are revenue producing. And one of the core components that we've been working with is something called a car equity line of credit. It's been our initial use case or test case. It's been very successful so far. The main premise behind it is if you own your automobile outright, you're actually able to take out a loan against it that is, and it's also secured by your vehicle then. So if your car is worth $5,000 and you own it outright, you can essentially borrow up to $2,500 depending on the circumstance, and then you pay the $2,500 back plus the interest. If you fail to pay back the loan, we can repossess the vehicle. The we that I'm using here is very loose. It's actually the loan servicer that does this. But at the end of the day, the DMM Foundation actually owns the rights to the vehicle in case the entity does not pay back the loan. So it's a very neat set of rules basically and flow of funds. But the idea behind it is we essentially use some very strong abstraction or interfacing that allows these different areas of the system to breathe. The users of crypto don't really need to understand the ins and outs of how a loan servicer is responsible for the daily collection of funds, managing the treasury, paying any fees off, following regulatory guidelines, issuing new loans, doing discovery of new loans and new assets and things like that as well. So the different layers of abstraction are also meant to let the system breathe a bit and really focus on its core strengths and competencies.
If you guys are a DeFi money market, is this loan servicer a totally centralized position? Is it this just one guy or one team that's in charge of picking what cars and which assets and taking care of the loans? Is this the kind of the centralized point? And how do you bring that to terms with this whole DeFi money market? Is there a way of decentralizing this loan servicer?
Yeah, so the really interesting thing with it is right now, where you see the protocol right now and how it's being operated changes over time. And right now we definitely are, certain aspects of it are inherently decentralized of our protocol, and certain aspects definitely have the training wheels on right now. So when it comes to the loan servicers, over time, the DAO itself is actually going to be able to vote on which loan to value ratios to potentially use, which assets are acceptable to use as collateral, and in which jurisdictions. Which assets you are looking at potentially are much more enticing or much riskier depending on which region of the world you're looking at. But the important thing actually isn't to look at each loan servicer as trying to decentralize them or trying to make them inherently more decentralized. Instead, the goal is to have a lot of different asset introducers around the world with different assets. And that's how we decentralize the protocol then. Because if we look at different risk vectors of these different organizations or of mixing real world assets, the risk comes from any one of these potentially having issues, whether it's regulatory scrutiny, one of them committing fraud, which is extremely unlikely because if we are looking at things that are regulated, then or them having other potential operating issues. Your main point of contact of the company gets sick and you have to talk to someone else for a week or 2 weeks or whatever, or goes on leave. All these different things become problems. But the biggest thing is if we can look at it from a situation of we have a lot of different loan servicers that have really strong organizational policies in place. That's how you can make the protocol more decentralized then. So if you look at the overall goal then of what we're trying to accomplish here, aside from offering yield and offering credit, it's really trying to build a global reserve index of real world assets that are revenue producing. It's about building a portfolio of that. It's like if you buy one of our M tokens that are interest producing, what you're really getting once the protocol is up and running for a number of years and we really built out this system is it's like an index fund of real world assets at that point.
Mm-hmm. Wow. And on the actual asset side, like if I'm the car owner, do I even know this is happening? Am I taking out my loan in Ether, or am I just getting cash and I'm facing with the loan source and I don't even realize there's this whole DeFi crypto market going on behind the scenes?
Exactly that. They have no idea.
Wow.
And different loan services are going to have different policies about mentioning where their source of funds are. Typically, like it's not even like a question that you'd ask from the prospect of getting a loan. It's like, you got the money, cool. Like you don't really ask where it came from necessarily. Most people don't even think to ask that.
You don't trust me. You don't want to ask most of the time where the funds are coming from.
Yeah.
But yeah, exactly. So then, what's the incentive for the loan servicers? Is it just providing these services to a DMM would get them a higher return, a higher fee than using whoever they would traditionally do it, I guess banks or whatever? I mean, why would the loan servicers partner up with DMM?
So it depends on which area of the world you're looking at, but the broad answer to this, like for most jurisdictions, is right now we're offering 6.25% interest to our on-chain participants that want the interest, that want the yield. And what's the flip side of interest? Well, someone's paying that interest for us to be able to get it. So the flip side of that is credit. And essentially what we're trying to do is democratize access to credit so that these individuals that are able to have access to these assets are able to offer or rather able to get access to credit then, and they don't mind paying more than 6.25%, because typically in a lot of areas of the world, these different lines of credit can be very expensive. So we're able to reduce costs there, which is one thing. And then by becoming a loan servicer, they're actually able to charge origination fees that can be, depending on the circumstance and depending on who their clientele is, pretty juicy to just not juicy and just a good business, but nothing extraordinary, so to speak. And so with that, becoming a loan servicer with us does offer the opportunity to offer those origination fees and offer better access to capital, potentially a stronger treasury, and more access to deal flow, basically, depending on which side of the business you're looking on, that is. So there are some very strong benefits.
I'm going to be honest with you. Just my first reaction, my first impression, it actually seems like a more revolutionary and decentralized, like ideological, like futuristic vision for the loan servicers than for actually the holders of the M token. And I'll tell you what, and that's really cool. That's a really cool product. But from what the way you're speaking about it, you're really putting the focus on the M holders. When for me, it's like, wow, you guys are like revolutionizing the loan service business. Because traditionally, if I was a loan servicer, if I wanted credit, I'd have to go to banks. And now all of a sudden, whoa, there's this whole decentralized community that, as long as I bring them loans, they're going to give me a steady line of credit that is set in stone, and there's set rules to it. So it really seems like for the loan servicing industry, you guys are really opening things up and really democratizing the loan servicing industry. Because on the flip side, if you're talking about just investments, I want to hold an M token, you're giving a 6.5%, 6% interest. I'm assuming that's a set rate. That's a fixed rate.
Yeah, it's a fixed rate.
Right, that's a fixed rate. So I mean, that could be found. That is, I mean, it's cool that it's backed by real world assets, but I feel like it's more unique on the loan servicer side, getting access to this democratized credit, than on the M holder side. What do you think about that?
I have two perspectives on it. So the first is
Okay.
knowing that both you and I are very well versed in the crypto industry. I would agree with you. I think that there's extremely wacky things being built right now. Where we kind of look at like just the idea of M tokens and getting access to steady interest, and it's like, cool, who cares? Like, where's the farming at? Where's like all the really cool staking things that are happening? Where's the composability with the rest of the ecosystem and all these wacky things that we see being built that are like mind-boggling? And we're like, oh my God, this is what the promises of smart contracts was all about. Then I'm going to flip that on its head and think, what if we look at also the, average people from the US, be it Israel, be it other countries around the world that are struggling to get access to a steady interest account, that are really, genuinely worried about the future of their savings or the ability to access to savings that are secure. Maybe these are people that are worried about bonds or the stock market or things like that, and just looking for some, hard assets that produce interest. This is the place for them then. And to hear that you can get access to a steady 6.25% interest for people like that is pretty mind-bending also. So yeah, I just think it really depends. It's been a very interesting journey because we have some people that see the merit of our vision on the interest side and get really excited by it. Like, oh wow, steady interest. The crypto space has really good interest or really bad interest. It always seems like it's very polarizing. Like, go lend out your USDC, you can get 1%, or when things get pretty hot, you can earn like 10, 12%, but it's always all over the place. But, you're telling me this is pretty stable. So that's pretty exciting then.
Mm-hmm.
But yeah, so it like really depends though. And it's been a very interesting journey so far to see like sentiment towards the idea of this strong stability change. But we're starting to see ourselves fit into a very nice mold of where we thought we would be, which is that we don't think that we're going to take over the entire crypto lending space. That's also not our goal. Our goal is to bring real world assets on chain and to bring new money into crypto. The money that we always talk about, like, hey, crypto needs to connect to the real world. How are we going to do that? So we see ourselves as a diversification point for those very pure crypto people that want access to stable yield, that wants some diversification.
Mm-hmm. No, okay, I hear that. And that is good. That is the sign of a mature market where there are both, the high risk lending as well as more stable lending like yours. So it is a crucial part for any healthy financial market. When people are actually putting in their collateral, they're putting in their ETH to lend out, and they get back the M token, M Ether, or whatever it be called. Are they getting? Is that representing the dollar value of their ETH or the Ether value of their ETH? As in, are they getting? Are they guaranteed a return on their 2 Ethereum, or are they guaranteed a return on their, at the time of their deposit, 2 Ethereum was worth $200, so they're guaranteed 6% on their $200?
It's actually ETH denominated, and so it's been a really popular product for us. We have this concept of a debt ceiling, which is essentially the max point where we're able to lend out funds. Like if you wanted to hand us $1 billion tomorrow and say, hey, I want $1 billion worth of M tokens, we wouldn't be able to offer it to you because our system requires that we have an equivalent amount of assets that back your deposits, basically.
Mm-hmm.
So once again, that's another place where we have these rules and the smart contract system come to our aid to add more trust to the end user. But the important thing though as well with that is the deposits that you make in Ether are all ETH denominated. And as a matter of fact, all of our tokens are the same way. Obviously the stable coins are more simple because they're always pegged to $1. So you can basically count in the fact that it's always dollar denominated. But yeah, any asset that we offer, it's always denominated in its original asset.
Right. So that kind of then has the opposite issue of a lot of the other just crypto-based lending platforms, where if the collateral backing, the ETH backing, the DAI or whatever drops in value, then there's not enough assets to cover the actual loan or principal. But here it's the opposite, because let's say I given 2 ETH. And I expect a 6% return, and there's a dollar asset backing it. There's a van that's worth $10,000. But then let's say that the value of the Ether skyrockets, and so now there's not enough of that real world asset to actually back the loan. You actually have the opposite problem that a lot of the crypto focused lending problems actually have. How do you overcome that?
Yeah, so the short answer for it is we actually don't have this proper solution in place yet, but we're looking at different ways to accomplish it. We, to be honest, we saw ETH as more of like as like more of a marketing stunt than anything,
Mhm,
because it was a cool way to get our protocol out there, and the fact that people are looking for yield on their ETH. So we launched that as a means to get access to it.
mhm,
And but the actual long-term solution that we've been actually getting closer and closer to specking out to see how we can accomplish this in a palatable way is through hedging. So
mhm,
the idea is that it's very easy to kind of speak about these different terms in hyperbole. Like ETH doesn't skyrocket overnight where it goes up
mhm,
10,000%. You know, it happens over time, but it certainly does move though, and and that upward volatility can be a problem. But there are
mhm,
ways to essentially hedge against some of those more rash moves that it can make. And if it does, then there'll be hedging costs that will essentially eat into the profitability of the DAO, but it's done to essentially cover any potential losses.
mhm,
So it's kind of like a spectrum. If you were fully hedged and fully protected, it would be extremely expensive to do and you would basically lose all your profitability. But if you didn't protect yourself at all, then you're exposing yourself to potentially too much risk and then losing profitability to upward volatility then.
mhm,
So there's a spectrum for it, and we're essentially working on talking to some very smart people where we can spec something like this out and put something in place that fits into our needs of decentralization. Because at the
mhm.
end of the day, those funds that need to get hedged are not ours; it's our users. So it needs to be handled properly.
Well, I have no financial background, so take this with a major grain of salt. But potentially look into this idea that the crypto-based lending platforms actually have the opposite risk. So it might be some sort of hedging being able to do there because they're worried about the price of crypto going down. You guys are worried about the price of crypto going up. Once again, I have no financial backing or knowledge, so don't think about it. But my next question is this. When we're talking about tokenizing real world assets, and so right now you guys are using this as a solution to actually have a real asset backing this loan that you guys are giving out, as opposed to other solutions available in the DeFi and crypto space. So when we're talking about which assets you could tokenize, you said you started off with vehicles. Now, vehicles, if I was a vehicle owner and I actually wanted to get a loan against that vehicle, um, there are options out there. You could hop on the New Jersey Turnpike and go find Tony. I'm sure he's willing to give you a loan against your vehicle. So there are options, but are there any sort of assets that kind of you weren't able to take out or borrow money against, but now because of blockchain and tokenization, this opens up a whole new world that suddenly you can now take out money against it?
Um, I think that the one that's pretty interesting, which I guess people would expect, is something like real estate. So, like real estate, for example, is an interesting one because it requires potentially a lot of capital to back it. Whereas the value of a vehicle could be 5,000, could be 10,000. As soon as you get into real estate, you're looking at least 6-figure or 7-figure sums, which gets pretty large.
Mhm,
Um, but I honestly like I think there's some facets of real estate that weren't necessarily possible. It's hard to articulate why because that's an area of the business I'm not the most well versed in because my areas of expertise related to technology. But there's a lot of abstraction from like how we bring the assets on chain that as long as like a lot of the regulatory modes for it fit and we're actually able to get access to a first lien senior secured position or the equivalent of that, a lot of hard assets aren't going to have a tough time fitting the mold.
mhm,
It's really about potential flexibility with how liquidations are handled for it in case the loan becomes insolvent against it. That's
mhm,
really one of
and-
the where the area of bigger concern I guess would be.
mhm,
I'd say the bigger concern, not bigger concern, the bigger surprising point for me was seeing the kinds of assets that people would want to tokenize and actually offer good returns.
mhm.
Like before this, I didn't realize that the car equity line of credit was a popular financial instrument and that it was um, a good asset to work with for something like this.
Yeah.
I think
I'd say,
everyone's go-to thing in their mind was real estate.
yeah. I mean, I guess besides homes, which is obviously the probably if you own a home, that's probably the most valuable asset you own. I'd say the second most valuable asset that people own is probably their cars, and there are more car owners than there are homeowners, and households own on average in America 2 cars, and I think actually it's 2 point something at this point. So I mean, yeah, you probably wouldn't think about it because it didn't really exist, this whole ecosystem, but it's very exciting. I've always been curious for kind of, instead of like, listen, it's cool that we're taking traditional systems with traditional finance rails and decentralizing it and putting it on chains, and I always like new and novel things that you could actually do that you couldn't do before. And I was wondering if I don't know whether this will fit into DMM's future, or even if this is something that you just think could be built on a blockchain, but this idea of betting on people, instead of the asset being a car, it could be someone's career earnings. Let's say, for example, you're from New Jersey. I know Spencer Dinwiddie of the Brooklyn Nets, formerly New Jersey Nets. He tried to tokenize his NBA contract. The NBA said no. But let's say, for example, Daniel Jones, who's the quarterback for the New York Giants. And listen, it's unclear yet if he's going to be a franchise quarterback. If he is a franchise quarterback, he's probably going to see career earnings in the hundreds of millions of dollars. If the Giants decide this year that he's not in the future, his earnings are probably in the single millions or none. I think there could be a case here where, let's say you're Daniel Jones, you're like, I want to hedge my bet here. I'm either going to make hundreds of millions or nothing. So I'm actually going to put my future earnings, my future earnings onto the blockchain, raise capital for that. And so pretty much I'll say, I'll raise $50 million towards my future earnings. So I'm guaranteed $50 million. And anything else I make above that goes to the Daniel Jones token holders. Can you see people being this real world asset that is backed by a crypto loan?
Well, I guess it really depends on the amount of volume that these individuals are looking to do. I mean, just from hearing this example and now jogging my memory of when that player wanted to do that, a more simple way to hedge against this, if I were the player, if the NBA shot this down, is to go to a prediction market where there's people that have an appetite to bet on this kind of stuff, and just bet against myself. If the bet for myself is that my career does really well, my contract takes off and I make a lot of money. The flip side of that is, hey, I just suck. I sucked and I just got injured, whatever it might be, and then and my career didn't progress the way I wanted to, unfortunately. So the easiest way to hedge against it, if I were that player and the NBA shooting me down, is to go to a prediction market like Augur. And if the prediction market doesn't exist for it yet, creating it, and then just betting against myself, and then seeing who wants to take the opposite side of that bet. So I could definitely see a lot more potentially cases like that come up where people want to raise capital, and that's where you're looking at really big money. But I think there's also going to be a more of a booming market for these prediction markets as well. The idea that prediction markets beforehand, I think, were very siloed because of different betting regulations, but there's a lot of regulatory arbitrage that's going on with these prediction markets that lets people do very interesting things. And I think that there will be more categories like this popping up that make these kind of bets more possible. Maybe he's not going to be able to tokenize and raise $50 million on it, but maybe every season he can make a 6-figure bet, which is good enough to live at least in case he gets injured or has a potential problem.
Mm-hmm. And if your whole goal here is, like you mentioned, eventually the dream or the goal here is to get enough varied assets under management. So essentially it's like an index fund that's pretty stable and secure. So at that point, it isn't a quick, easy way of kind of filling up that portfolio. Why don't you just tokenize, the S&P 500 and toss in there some government bonds and just really just have it seems like there are a lot of assets there that are kind of easy to just toss in there into the basket to be a kind of traditional index fund that is stable.
Yeah, it's a really good question. The big thing though that we're looking at is the broader ecosystem like right now, the economy of the world right now, is that a lot of things are running in fractional reserves. We have a lot of countries that are moving towards negative yielding bonds. There's a lot of fiat debasement happening. The stock market's all over the place, and oftentimes based on the fact that there's stimulus packages coming out or different incentives coming out that allow for stock buybacks, which leads to higher prices. And it's just not the kind of thing that we want to bring ourselves to get associated with. And I don't mean that in a negative way. Like there's a lot of room for these things in people's portfolios, and obviously people have built massive generational wealth from investing in those things. But at the end of the day, we see ourselves as more of this thing that's operating around the world. And the stock market might be a good investment for certain people in certain countries, but then it's not a good one in other countries, for example. So the big thing is, we said when we first created the project, we kind of set up these three core pillars of what does it take to be added as an asset to our platform. Obviously, stocks and bonds are different kinds of potential assets if you own the right side of them, of course. But from our perspective, what we really wanted to do is build up this criteria because we believe in this fiat debasement in this issue, and we think that hard assets in a inflationary in an inflationary environment, that was tough to say, it was a tongue twister, is the best way to hedge against potential volatility in currency. So for us, breaking it down to those three core pillars, you have to have a senior secured position, a first lien senior secured position against the asset, which is something we already brought up and talked about. The asset has to be over collateralized on an income production basis, such that it produces more interest than we're paying out, and it also needs to be over collateralized against the loan itself, so that if we're loaning X, it needs to be worth at least X plus Y. And if it doesn't fit into those three core things, then as of right now, we don't have the appetite to list it as an asset. And sometimes it gets more nuanced than that, but stocks unfortunately aren't going to fit into that because it's inherently not a loan that's being backed by something. Bonds are closer to fitting into that, but it's really backed by cash flow than it is backed by something that's a hard asset, unless it were secured by something. So, it kind of breaks down into, okay, which bonds are potentially feasible. So if we just look at instead like the most basic of things, and not really try to get into more complex financial instruments, like, oh, maybe certain classifications of bonds would work under certain conditions. And we instead just keep things very, very simple, the whole entire keep it simple, stupid idea, that we're able to build out a really, really nice protocol. And maybe things get built on top of us instead of us trying to build on top of other things that are potentially fractional by nature.
Yeah, keep it hard, keep it real. I like it. You're trying to do a lending service that adheres to the principles of the crypto sphere and of decentralized finance. So, Corey, this was a little short. We ran out of time, but it was a pleasure speaking to you. And thanks for answering all my questions, even if they were a little pointed. I think you did a wonderful job of answering them. So I do appreciate you taking the time. It was wonderful speaking to you. And for all our viewers here at REIMAGINE 2020, I'm Yonah Hochhauser. Happy holidays.